Hey, Crypto Hotep here with another investing video, week number 5 for the family portfolio from One Finance. And as always, if you're unfamiliar with the methodology for the family portfolio with M1 Finance, please take a view at week 1, which I go through the reason for the portfolio, how my family comes into play, and the reason for the stocks that have been picked. Um, so, with that being said, and before we go through, just a quick PSA: none of this is financial advice at all. Please consult a professional before you invest or trade into volatile assets like stocks or crypto. These videos are primarily for my own edification and tracking the investing journey. And we can jump right in here. So, with this, before we go into the portfolio, we'll go back to last week. So, last week on Twitter right now for last week, the family portfolio netted a week ending balance of 523.50, with a couple high performers. My wife's Celsius, fourth week in a row, which has been crazy. The worst performing asset, our youngest Apple, second week in a row. So let's see where we are right now. As of right now, we do have a decline. So as we can see here from last week to this week, we do have a decline from 523.50 to 515.09. In all honesty, stocks took a beating this week primarily. So this is not uncommon here to see with our portfolio here. So we can jump in here. So the balance here, 515.09. And the weighted return currently year to date, these are year to date numbers, dropped to 3% because last week we were at 6%. So 3% currently. Dividends have increased, and we'll go into the dividend activity. And we will go into that activity right now. We haven't had any buys. These were the last buys that we had. And we did go over that in the last video. But we did have some dividend activity. So we did have some dividend activity from Nike. From my previous videos, I believe it was week 3, I did take Nike out to supplement with TJ Maxx. Wasn't really feeling the Nike stock, especially after their earnings call. And with the earnings, Nike did note that there were a lot of competitors coming into the market, and that they were some of their advancements in the shoes have somewhat stalled out because of the competition. So I did take Nike out. I did not like the financials either, but you still receive a dividend for Nike because of the amount of time that I had held it. So we did get 6 cents here. We did get Walmart, 2 cents for Walmart. Coca-Cola, as always, the king, the goat, 8 cents. Domino's Pizza, 2 cents. And then the ever consistent Kraft at 7 cents. So we did receive a little bit. Again, shavings make a pile. I'm not really focused on these amounts, more on the consistency and obviously building my positions up. So then those dividends can be built up as well. Going into the portfolio, we can see, we'll go from bottom to top here. So youngest red portfolio all around here. So Tesla, trying to find its footing currently. Elon did tweet out that robo taxi will be unveiled next week. So all eyes will be on Tesla. We'll see if that'll make a big jump for next week. Apple again, um, just kind of the same at the same rate that it was before. And then Nintendo down a staggering 10% here. And I will do a little deeper dive into Nintendo next week just to see what's going on here. Again, really with these stocks, we're not too concerned. You can see the rate of return. We are down 8% year to date for our youngest. But again, because of the age of our kids, they can adhere to a little risk here. So not really concerned with the stocks here for them, but just something good to note. Let's go to our oldest. Oldest again down 8% as well. Again, Apple, right? So Apple taking that dip there. McDonald's also did take a dip as well. So that's gonna add to that, to the overall redness of that portfolio for our oldest. And I think the good thing is I saw a tweet from the dividend investor today, and it had Jack Bogle, the investor, on, and he specifically said what to do during market declines. And he said, don't stop the cruise control way of investing. So don't actually stop investing when the market declines. Keep that DCA, dollar cost average, going. And obviously know your levels on where you want to, say, purchase more, but don't stop that, because doing the dollar cost average and compounding makes its weight in gold when the market is declining, because the market will eventually turn around. Let's go into my wife's stocks. Up 10% year to date. As we all know, that's not rare here because of the stocks she holds. She is in the green again this week. My wife was in the green last week as well. And Celsius up 15% year to date for this week. Fantastic. Google up 8% and Pepsi up 2%. Overall, my wife's rate of return for her stocks a staggering 10% year to date. Fantastic. Let's go down here. Let's go to our middle. Middle down 2%, so not too bad, but Amazon kind of on the shoulders of Amazon. Amazon has been ticking up, has been increasing as of late. So up 6%. Nintendo, similar to our youngest, who also holds Nintendo, so down around 9-10% there. And then Costco down 3%. Again, not really concerned, especially with Costco. Costco will rebound. Not really worried about that. And we will go to mine. Mine's up over 0.5% year to date. And let's see what we have cooking here. So going into the ones that are down the most, we have pharmaceuticals. So J&J and Pfizer, despite the good news with J&J about the acquisition that they just had today, still down year to date on the pharmaceutical slice of my pie here. Not really, I'm not concerned with that. Real estate, let's see what real estate looks like here. And we have Public Storage and then Federal Realty Investment. They're kind of split. Public Storage and then FRT are split here. Not really worried about these as well. I feel good about these stocks. We'll go into restaurants and food. Coca-Cola is the GOAT when it comes to the dividends. They stay chugging along, up year to date 1%. Domino's Pizza is on a tear. Domino's Pizza has been on a tear for the past 2 weeks, up 10%. Hershey's, and then, we saw with our oldest, McDonald's down almost 10% at 9.2%. Starbucks is bleeding out as well at 4%, but I do like Starbucks. I like Starbucks as a stock and as a business. So I'm glad I'm still accumulating Starbucks. And then Texas Roadhouse down less than 0.5% here. All in all, I feel really good about the stocks. Finance, we have only one up here. We have our Aflac, Moody's, Amex, and Visa all down very slightly. Not really worried about those. Industrial's up, and I did see the shift in industrials, especially with the oil shift. So this doesn't surprise me at all. So industrials, energy, oil, all in the green, right? Um, we haven't added to Exxon or Union Pacific as of yet, but Caterpillar, Deere, Chevron, Duke, Cintas, which we will be going over in our stock analysis, and then Waste Management. So these are all in the green currently. Deere, John Deere, and Caterpillar up double digits at over 11%. You'd love to see it. Consumer staples. I call these old reliables. Consumer staples are like the engine that just keeps going. So a little bit of a mixed bag here. We have a couple standouts. Kroger has been hitting all-time highs for the year. So they are up over 6%. Kraft Heinz, who we got that dividend from earlier, up over 5%. McCormick, who I actually called out in a tweet for an ascending triangle pattern right before earnings, and it gapped up. They are up a staggering 11%, and they were still up after earnings. Colgate, up almost 1% here. And then the rest of them, slightly down here. TJ Maxx, we just added them down 2%. I'm not worried about this being down 2% because we did add them as they're on that trajectory up. So right now they're kind of in a resistance phase with price. So not too shabby here. And then last but not least, my favorite sector, technology. Technology, Apple, kind of stagnant. My Apple position is stagnant currently. Google, up. Similar to my wife's Google, up. Amazon, similar to our middle, up. Microsoft, same breath, up. NVIDIA, down 3%. NVIDIA will be rebounding. Meta, up. Coinbase, all day, up. I think with Coinbase, with the crypto alt season that I believe is going to be coming, you have Bitcoin halving in 2 weeks, or in less than 2 weeks, I should say. Coinbase, you'll see an uptick in Coinbase. AMD down about 20% here. The reason this is down over 20%, is there was a strong rejection. This price is still in the golden zone for me for AMD, so I'm not concerned about this at all. And then Broadcom just keeps chugging along, up over 1% here. So all in all, did take a little bit of a slight step back in the family portfolio, but that is common with stocks. You will see pullbacks, so we're seeing a pullback here. But ending balance 515.09. We do have some buying power, little buying power here that we may kind of send to the family stocks here. We'll see. But with that being said, we will get right into the stock analysis of the day, and that is Cintas. So Cintas, I found, I believe, on YouTube with one of the dividend investors I do follow. And they were analyzing Cintas, and it intrigued me a lot because Cintas reminds me of a very long-standing company similar to like, an ADP stock, a dividend stock, where they have a tried and true business model. It's simple and it works. And it works whether it's in pandemic era, whether it's in market crash, they're still chugging along, and that's what Cintas is. And Cintas is that uniform company. That's what everybody knows it for. It obviously does more things other than that, but that's where their bread and butter is currently. So we can look at the overview. So what their business model is they basically rent clean out uniforms for different companies, and it's literally, no pun intended, rinse and repeat for for all their clients there. You can see their revenue and earnings here. They do have a buy and a strong buy from the analyst forecast here, and then we can jump right into those financials. Um, the financials are very strong with Cintas. You can see here, um, 2021 did take a hit, obviously, from that prior year, but they have since rebounded substantially. And even though they did take a hit, everything's been in the green on revenue side. So they rebounded substantially to the point of 2022 was 10% revenue growth, and then 2023 was 12.2% revenue growth. Okay. Um, Another thing I like to see is free cash flow. Free cash flow has been on the upswing substantially with Cintas. Okay. And let's go into balance sheet here. Cash and cash equivalents have been a little bit of a mixed bag here. I did see this. It's been a little up and down here. Cash growth, similar, very up and down. So those I did keep that in mind. Um, Total debt, they've actually decreased over time. That was a mixed bag, but the current year they're actually in the green for debt growth, which we do like to see. Okay. And then retained earnings have also increased. Now this has increased year over year, as you can see. And this is something that I like to see in retained earnings is money that the company can put back into its operations and hasn't been paid out in a dividend. And then on the cash flow, with net income, their net income has also increased very steadily over the years. And that's something that I love to see here with net income. Their dividends paid have also increased here, as you can see. And we have a positive net cash flow as well as of right now. So a lot of good things that I've seen that Cintas has in their balance sheet, in their business model, just makes it a definite hold for me. And they are a dividend stock. And we can go to those dividends right here. Their dividend growth over the years, 43 years of dividend growth, 18% dividend growth, and their payout ratio is below 60 to 70% at 39%, which is fantastic. Annual dividend is $5.40, and the dividend yield is only at 0.8. But when you couple the fact that their dividend growth is 18.18%, and they've had growth for 43 years, I'm okay with the 0.8 starting dividend yield as of right now. Okay. You can see the full history of the dividend, and the cash amount has increased as 2020 did happen. You can see that dividend yield or that dividend cash payout was cut but we've slowly but surely have increased it and got it back to 2016 numbers currently. You can see that once that 2020 hit, you can see the decline here, but you can see the progression getting back to where it once was. So all in all, this is a very good stock that I have, Cintas, and it's in my industrial grouping of stocks, and I feel very good about this stock. It's a boring stock, but sometimes, and I always say this, sometimes boring is actually good. It's very consistent. You can count on it. So with that being said, guys, I'll cut this video. And as always, if you like this video, feel free to comment, subscribe. Let me know what you think. Let me know what other stocks you may want me to look at and analyze. And as always, happy investing.